All right, folks, we made it. Trading Commodities, Part 8, the finale, Managing the Position Flip. I am Keith Harwood for Option Hotline, where research meets strategy. Let's get to the disclosure so we can get to this exciting finale. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please read through the incredibly exciting disclosures so that we can get into the much more exciting content. All right, me again. Always me to start. So, one of the things that I like to talk about here as I go through all this stuff is the trading systems themselves require discretion. That's where I get myself involved. Without discretion, I don't necessarily get to create as big of an edge over the marketplace. So I like to apply my discretion in a number of ways, but a lot of it is off of my options expertise, right? So if I can create a rules-based system, such as in the core commodities or in our big league stock program, that's got positive expected value, then I can use my expertise and my experience to add another element of edge via the option markets that I've had so much success in for my career. So that's what I'm bringing to you guys here. That's what we're going to talk about a little bit more of today in terms of managing the position flip, because managing the portfolio is just as important as generating a good signal. If you generate a great signal and have the wrong trade implementation and then mismanage the flip, you can't make money. Okay? So that's all we're doing today, is just talking about managing a signal flip and how to handle that. So when my signal, my position's either always long or short. I mentioned this before. So I'm never flat. I need something in the market because my signal is always in the market. A lot of systematic signals are in that sense. So there are some that say, no, that we need to match these three criteria to be in. That's more of our big league strategy. It's not always in or out. It's either in. It's not always either a long or short. It's either in or out in big league. We have a lot more stocks to look at. In core commodity, I'm only looking at three: gold, silver, and oil. I'm trying to maximize return by being long and short at all times and always having an exposure to these markets and optimizing that exposure. So how do I handle that flip? I'm long calls. Crude oil falls 3%, and now my market signal's telling me to go short. What do I do? Well, I gotta manage this position. And how do I flip that position? Do I just immediately sell out my calls that have lost money and buy different puts? I gotta be honest, it's different because it depends upon what the flipping signal is telling me. What if crude rallies and on the day it rallies, my signal is flipping short? Well, now I have more leverage, right? Unless I think that we're just going to consolidate based upon other technical signals and based upon other discretion and based upon what my volatility metrics are telling me. So I have to go through each one and look at how I can leverage the flip days, because for me, the flip days are some of my highest return days. So I have to determine what kind of flip we're doing. Is it the end of a prior trend or and a new consolidation period or a big new trend? And how do I position when I do that? Well, my flipping days have been high return days, so I generally think of those as potentially good leverage days. But the market has to provide that leverage. If I can't get cheap leverage in the options, then I'm overpaying for leverage, and that's going to be a mistake. What if we got that big lag like we've got in gold, silver, and the yen right now? Remember, I told you guys, I think that gold and silver, the big potential move right now could be to the upside to snap back in line with the yen. So if I start seeing the dollar weaken, and that creates a snapback in gold, and my signal flips long, how do I want to position? I probably want more leverage. But if I still just get this continuation where it says, if I was long and it flips me back to short, maybe I don't want as much leverage because I don't think that the leverage move is to the downside right now. So I have to look at how those options are priced, how that skew is priced like we talk about. What macro inputs could come to the market in the coming 24 hours? What if I get a long oil signal and tomorrow OPEC's meeting? How do I want to position? Maybe I want that strangle now if the market's cheap. That ratio strangle, because then that protects me on the downside. And if we get a major move to the downside, I'm actually making money in spite of having it wrong. So that's what I spend, as I mentioned before, a lot of my time doing for core commodities is I spend a lot of time structuring these trades and figuring out the best way to utilize the leverage in the options markets. If I see a leveraged event, I want leverage. How do I get that leverage? That's the play, right? That's how I get into that dollar risk sizing or the risk weighted sizing with a ratio, strangle, something like that. Complex position that can really leverage a move. Because those flip days are the days where I have to go more complicated. When we're just in a trend, I want to apply more of the strategy that I use for big league options. A little bit more stock-like, right? I mean, and on that note, like if I think this is going to be a slow move, then I just want a stock-like position. So I'm going delta weighted in the money options. If I want that big move, I want at the money or out of the money options or something complicated. You know, I'll give you that example again. We talked about that ratio strangle. What if I think we're right here and then my signal says long, but my fear says short? Well, what if I just create this signal, this setup, where if the market falls back down, I lose, $130 instead of $176, but I have all this extra leverage for the rally. That's a good idea for me. So I'll put something like that together. And if I just think that we're going to grind higher, I want something that looks like an equity risk, not like this. Because this has theta and vega risk, which is what you can see from passage of time driving lower. So this is the ratio strangle play if I think there's a flip with a big position move the other way. Possible. Gets complicated. Easy one for you guys to wrap up the course here. Am I ever out of the market in the core commodity strategies? No, of course not. There's always a signal for me, and I just have to look at how to leverage it. And that's where I'm introducing to you guys the core commodities option trading program. I'm the portfolio manager for it here at Option Hotline. Go to optionhotline.com/core commodity, and you'll find out more about gold trader, silver trader, and oil trader, and how you can take the trio together from the core commodities instead of just buying them independently. It gets you a better price if you buy them as in bulk, and gets you exposure to some commodities and some diversification to your trading education. Learn more about commodities, learn more about commodities options trading at Option Hotline with Core Commodity. Take a look now, please. Thanks again for taking this journey with me through the commodity trading course. And I hope you'll find more information of value to you in the core commodity trading program. Thanks again, folks.